Well, hello and welcome to Trading Blows. In today's show, plenty for myself and the panel to dig into, including whether the recent sell-off in Treasuries has more room to run, what surprises the ECB may spring in their latest policy decision coming up on Thursday lunchtime, how the economic outlook is evolving here in the UK, and also how markets continue to trade elevated geopolitical risk as conflict continues in the Middle East. It's a busy show this week, so without further ado, let's roll the titles and get into things. So a lot for us to discuss this week. Let's meet our panelists, as always, going head-to-head over 4 rounds, scoring points for a great response, with the threat of points being chalked off, looming over them if a dispute, is raised over their answer. Of course, the better their responses, the more points they will score. Joining us this week, Richard Matthews, the holder of a ridiculous number of wooden spoons and the head of FX and payments at One.io. Ioan Smith, a market veteran of the sell side and his own proprietary research firm. And last but by no means least, power permitting, Arno Venter, a market analyst from down in South Africa. And Arno, just to reiterate, if you talk about the rugby or the cricket today, we are going to have to eject you from the show, I'm afraid.
Lips are sealed.
As they should be. Right, with Arno fully forewarned, let's get on to the first round. So I guess there's really only one place to start this week. I was away last week and coming back to my desk on Sunday, firing up Bloomberg. Really one thing caught the eye, and that was what continues to happen in the Treasury market. Although we've seen a little bit of demand begin to creep in over the last day or so, Bill Ackman and Bill Gross covering their shorts and starting to buy into bonds, it does seem like the sell-off still has some momentum behind it. So, Dick, let's start with you. How much higher do you think yields in the US are going to go from here?
A lot. there's a simple.
Well, it's answers like that get you the wooden spoon.
Yeah, I think you're certainly going to see 6%. I'm actually in the camp of Jamie Dimon that you might see 7%. I hear gasps of shock horror in the background. I thought it's really interesting about the two bills. Have they really gone in there and announced what they've done? Are they not just trying to get the market into a better place to sell more? I just thought it was a strange thing to show your hand like they did last weekend. I think looking at it, I made some notes and thinking about Treasuries last night. I can't really see any reason to buy them unless I was short covering. You're going to have more spending on defence. Biden's trying to get this $106 billion package through to help Ukraine and Israel, which I think is only the start of things. The deficit, is ridiculous. You've got no real leadership in the House in the States, so I think that's very, very worrying. And of course, inflation, I don't think it's dead. I think it's going to come bouncing back. I think that what's happening in Israel will lead to further inflation, which we'll come on to further on about geopolitical risks. But I think anyone who thinks inflation is dead and buried is gone. And you've still got to fund their deficit. And they are in competition with us, with Europe, with everyone, trying to balance the books after COVID. You've got China probably not buying as much as they did. I don't think the Saudis will be buying. You've got a whole tranche of the world now against America. So I think they've got that problem. I think Powell actually last week was hawkish, although some people didn't think so. I think he's still hawkish. To me, I think I'd be a seller, and I do think that they will go to 6%, as I have been saying for some weeks now.
You have indeed. It must be said you've been bearish on fixed income for some time, and that view is certainly beginning to bear even more fruit than it was a couple of weeks back, isn't it? Ioan, are you on board with that bearish side of things, or are you starting to think that actually there might be some value in long duration debt at this point?
I'm actually surprised that Dick didn't go the Rick Santelli line. And back earlier this month, Rick Santelli said that the 10-year could hit like 13 to 14%.
I wish I'd seen it.
Right, October the 3rd. I think that's when he did it. I think you'd enjoy that episode because he'd written the whole thing on a piece of paper, so it would be right up your street.
There's a man who doesn't support a decent rugby team. He's busy watching things on October the 3rd and remembers the actual date.
Don't need to watch rugby. It's all memorized.
Oh, okay. My memory doesn't go back that far.
I mean, like Dick was saying, the inflation. If you look at it, the current core CPI. I mean, you could easily call for a normal sloping curve, the long end between 7% and 9%. But I mean, for me, these type of headlines, sometimes this just feels like the top is in when people start throwing silly numbers out. Again, we can hark back to the US debt levels. If it did get to that 9%, and then what Santelli was talking about, the 13.5% to 14%, then obviously that'd be catastrophic. But I mean, once they sort out the house in the US, I think they have to get a grip. But I don't understand all this money that they're trying to raise just to send it abroad to Ukraine. It just doesn't make sense to me. Having said that, I do like these levels on the 3-month T-bill rate. I mean, for 3 months, like if of almost 5.5%. I mean, that's not bad, right? You did refer to Bill Ackman and Bill Gross.
Who was that?
What was that?
Did you know Bill Gross? Like the guy who sat through the biggest bull run in bonds that there's ever been, and you just sit on CNBC saying whatever he wanted to, like with all that assets under his seat. But I mean, I'm not really a big fan of copying the hedge fund managers. I think obviously a lot of them they'll advertise their trades after they've built the position, and then hope the rest of the market will pile in, and then they'll get greater returns. But having said that, I mean we're at similar conditions now, like back in 2018 when like Berkshire Hathaway, I think would be more of a weight or credence to these particular type of trades. I think Berkshire parked a hell of a lot in T-bills because they were treated better for tax reasons than dividends. So I don't see why they wouldn't necessarily do the same thing now. I mean, and at the time they were struggling to invest in companies because everything was so expensive. So it's more or less similar conditions to what we've got now. Yeah. Other corporations, I mean, they park their cash piles into corporate bonds, but do you want to be in corporate bonds at the moment as well? So there's elevated risks on that side. So I'd look particularly the short end, especially the 3 months for 5.3%. I like that. And CTAs still have very low exposure to bonds. But on the flip side, I know you were talking about, the 2s, 10s sort of signaling, a recession, but I don't think we should fear recessions if you're trading anyway, because it just provides you with opportunities. And at the same time, the Fed's QE and other, central banks, I mean, they've distorted the curve enough, to diminish its sort of signaling ability anyway. So I do like the short end. I think it probably has a little bit more to run, but again, I think if you focus more on the short end than the longer end, I think you're in a better position.
Yeah, absolutely. It makes a lot of sense. And I think your point around the curve is a good one, because it has been incredibly distorted by what central banks have been doing, over the last 15 years or so. I guess it is now going all the way back to 07, 08. So I'll throw the difficult question to Arno. This big bear steepening that we've seen, the 2s, 10s is getting back towards zero. The 2s, 5s is on its way there as well. What does it all mean? What do we make of it?
Look, there's a lot, like you said, a lot of recession calls right now, or at least the increase of it again, based on the steepening. But I think it's important to look at why the reason why we normally or usually have a re-steepening is because the markets are starting to price in Fed rate cut expectations, right? And this time around, we're not seeing the re-steepening as a result of that happening, right? Twos are basically flat because markets think that the Fed they're basically done hiking rates. But we've seen tens rapidly rising because that higher for longer theme obviously requires a slightly higher term premium to be paid in. The other thing to keep in mind about the reason why we've seen, I think, an increase in the re-steepening, if you will, is because of the issuance, like Ioan said. I mean, issuance has had a huge impact on the bond market, and it's been more pronounced at the longer end of the curve, right? Because if you take a look at your long bond, especially that 30-year auction, the further out the curve we go, the demand is slightly less. And I think to Ioan's point, I think a lot of players rather likes looking at the shorter end of the curve right now. So when you've got a demand issue and you've got term premiums increasing, I think that can explain a lot of the re-steepening that we've seen, because we're just not seeing that I don't think this is recession fears like we normally have, because it's not rising for the same reasons that we normally see it happen. There are some, as always, some Scandi and Italian newsletter writers out there, that expects many things to break, but the markets have been expecting things to break since March already, right? So for now,
2007.
Say again?
It's been expecting things to break since 2007, 2008.
Exactly. So, for now, the data looks okay. Yes, depending on who you ask, there will be things that, looks bad right now. Sentiment was down, delinquencies is up, high frequency, consumer spending took a hit as well. But broader market measures like overall growth, inflation, labor, all of that is still holding up okay. There was a research note that I went through, I think it was last week. I can't remember who it was from, but they mentioned that even though consumers... Definitely not. There were some good insights in this one.
ABN Arno.
It could be. It was something like 200 billion that consumers are spending more in interest. But at the same time, with a 5% interest rate, they're earning something like 80% of that anyway. Companies were able to generate massive amounts of interest now on their cash holdings as well, which is good for them. Mortgages, even though trading at 8%, think about how many times we've seen 8% mortgage rate charts over the last 2 weeks or so. The thing is that if vast majority of mortgages are pinned below 4%, it's not going to have the impact that we think it will. So I don't see this it can continue for as long as the issuance problem is there, for as long as the market requires higher term premiums. But I don't think it is, imminent recession signals that we're seeing right now. And yes, I can already hear a lot of people out there, saying respect the lag, but saying respect the lag in a situation like that it's less useful than a New Year's resolution. What can you really do with that information? How can I put on a trade by saying respect the lag? So what do? Do I just sit out of the markets and do nothing until that eventual recession hits? I mean, it's just ridiculous. So no, I don't think it's it's obviously if you're in the wrong side of the trade, it's going to hurt you, this re-steepening. But I don't think it's recession alarm bells. I think issuance plays a big part of that. Term premiums plays a big part of that. Obviously, demand linked to the issuance as well. But I don't see the calls for a complete shit show at this stage. The data still looks okay.
No, I would agree with that. And I think also we're talking about a recession, and I know I brought the subject up, so apologies for that. But US GDP for the third quarter is due on Thursday afternoon, and it's going to print the 4% handle. It just feels ridiculous to even bring the subject up. Dick, I can see you disagree. Go on. You're bubbling away there.
No, I don't disagree. I think it is a lot down to issuance. I think, as I was saying, that the deficit is so huge, they just, let's give 100 billion to Israel and Ukraine. And I'm not saying you shouldn't do that, but it's sort of like tossed in there. What's 100 billion between friends? It's nothing when you run a deficit of God knows how many trillion. Yeah,
but that's like 2 weeks issuance at the moment. It's like, it's not. Yeah.
It's like 2 weeks wages to my issuance.
I mean, those are the silly numbers that they're throwing out. I mean, the early part of this month, that's what they were issuing every two weeks.
Yeah. But how's the market keep absorbing this and keep absorbing it? I mean, you'll go back to have a good old-fashioned buyer's strike. and then you'll really see, excuse my language, the shit hit the fan. I think that's, to me, a base worry there.
No, I think you're right. And of course, the other thing, excuse me, to keep an eye on is the quarterly refunding. That announcement coming, I think, on Monday. So we're probably going to see all of the auction sizes up pretty significantly once again to fund all of this. So it'll be interesting how the market digests that. I'm sure we can get onto that next week. Before that, we've got plenty more to discuss in this week's show. So let's get on to the next round. So I'm loath to bring up recession. Something else I'm loath to bring up is the European Central Bank. But given that we have their policy announcement on Thursday lunchtime, we should probably mention them anyway. Ioan, let's start with you. I mean, pretty much everyone is expecting the deposit rate to remain unchanged at 4%, which is a record high, we should mention. Do we think there is any chance whatsoever that the ECB could surprise us tomorrow lunchtime?
No.
You've turned into Dick with these one-word answers.
Yeah, more or less. No, I think there's much broader consensus in favour of no change going into this one than there was probably last month. I mean, last month was clearly far from unanimous. But I think since then, we've got. It looks like inflation's starting to behave itself for the time being. Probably before it starts to reaccelerate higher again, I think. But like you said, the risks of recession in the Eurozone, people are starting to assess those risks now. And basically the effects of this massive tightening since July 2022. I mean, the rate or the velocity of this increase that consumers have to swallow is just incredible. But having said that, I mean, the expected easing that the market's pricing in from next year, I mean, it becomes slightly more cautious now. I think we're around the 3.4%. But I mean, that's up about 15 basis points from the last meeting. So expectations are sort of stabilized a little bit, but even the ECB's own consumer inflation expectations, which is actually a really key input into their policy decisions. I mean, that's deteriorated since last month. But even the Commission's own survey, especially for the services selling prices, which is a major focus for the ECB. I mean, that's fallen to its lowest level since September 2021. So I think they're probably more or less now at that level where they're just at wait and see, especially until they go on like Christmas holiday from next week. But I mean, if you're looking to trade the euro or something on the back of that, I mean, momentum indicators they look constructive. The 5-day moving average is around 105.65, something like that. So we've been trending around there. But I think, there's little enthusiasm for the market to push it above this. So everything is sort of sideways trending. But I think a move above 106.40 around that, that's where you're going to need to see buyers coming back into the euro or trading here especially around this decision.
Yeah, definitely. Dick, I'm keen to get your thoughts on the ECB. I mean, I read an article, Bloomberg put out a piece over the weekend, or maybe it was Monday morning, talking about how a lot of money managers in Europe are starting to bet that actually, despite the guidance and despite all the commentary, the ECB may not actually be done hiking. I mean, if you look at what's facing the Eurozone, you've clearly got downside risks in terms of growth. You've got upside risks on inflation. You've got the situation in the Middle East as well. I mean, do you think the ECB are done, or do you think that there actually is a chance that they go again at some point? I mean, overnight, we're now talking the RBA may hike again in November after having been on pause. Do you think a similar situation might happen on the continent?
I don't think they'll hike tomorrow. I do think there is a very real danger that they'll hike again. Inflation is clearly not dead. Winter's coming. Oil's going to start rising, which we'll come on to later on with the situation in the Middle East. A couple of things are happening in the background which haven't really been picked up. That the gas pipeline between Finland and Estonia, the really esoteric things that you watch, suddenly blew up for no reason. I think there's been some problems with telecommunications as well. So it just feels like there's going to be a little bit of a squeeze coming from further east. Add in, weather uncertainty over crops and bad crops. Cocoa, which is one of my favourite crops, is at record highs. Shortage of rice. So I think inflation is lurking away there, and I think it will come back in. And I don't think that they are done. Although PMIs were less than impressive, IFOs were pretty much in line today, I think. So I very much think that they'll play a wait and see. They'll do what their speciality is, that they'll fudge tomorrow and they'll just waffle on. Unfortunately, I've got a very long lunch, so I won't be watching that. So I'll leave that over to you, Michael, which I'm sure you'll text me and tell me what's happening. I think probably the most exciting thing that we're going to gamble on is what colour Christine's going to come out. Is it going to sort of be? Is she going to go the full Trump yellow brown, or will she stick with the sort of the wooden spoon colour?
Well, you would know.
I'll certainly give you a match on the colour. Will they play around with some of the details with bond purchases or whatever? I'm not sure. I just think that they'll fudge tomorrow. I think that another hike is certainly on the cards. But my favourite subject, as everyone knows, money supply is still weakening in Europe, which to me is normally a sign of recession. So on the one hand, I've got a lovely recession coming because of money supply. On the other hand, increases in commodity prices squeezing inflation. So I guess that friendly old stag comes out, and you could be looking for a period of stagflation over there.
Well, that's a nice and optimistic view as ever from you there, Dick. The trademark pessimist of trading blows.
That's despite my and my wife's best efforts to boost the French economy single-handedly when I was in the south of France a couple of weeks back.
Were you in the south of France?
He hasn't mentioned it, has he?
Yeah. You haven't mentioned it at all. Oh, yeah.
Working in Monaco.
Yeah.
No shortage of funds there.
No, I can imagine. Very much like Geneva last week. It's interesting you bring up bond purchases. I did read a few weeks back. Some were expecting that the ECB may start to tweak the timeline of ending PEP reinvestments and all that sort of thing. I mean, Arno, I'm keen to get your view on this, but in my mind, I think it's at the point where you look at the bond market. We've had a pretty aggressive sell-off. The BTP Bund spread is at, if not just above, 200 bips. So to me, the chances of them doing anything on that front are pretty slim, I would say.
100% agree, mate. That's exactly what my counter argument would be for any expectations of a change.
I've stolen your thunder now.
Yeah, I mean, you've just literally, you took my notes away. So, but no, I totally agree. BTP at twos, why would they do anything to upset that? I don't think they're going to be moving forward with their PEP or cutting down PEP reinvestments anytime soon. Markets expect that to be next year. I think they're going to stick to next year. At this stage, like the guys already mentioned, there's really just no reason for them to do anything meaningful tomorrow. Same story for today for the BOC as well. Based on the recent data, both of them can basically just leave their statements exactly unchanged and just go on about their day. I don't think we're going to get any meaningful changes. Something that I think is quite interesting, though, is that everybody believes they're going to be higher. It's going to be higher for longer. But the market's idea of higher for longer is basically 6 months, right? Yeah. Because the first cuts are priced for July or June, and I think the next one for the Fed for July. I think the markets are too aggressive on that view at this stage, but obviously we're not going to get anything out of this meeting to change that. I just thought that was a very interesting thing to look at. Everybody's talking about higher for longer, but it's basically 6 months if you take a look at money market rates. Right now, I don't think they can afford to come across dovish in any way because of where inflation is sitting, like Dick said. I think they have to at least keep that optionality open and on the table for them to hike. But again, based on where growth is right now, they can't really do anything in terms of tightening. So I think they'll just stick to the exact same script. As always, the risk to the euro is probably tilted to the downside with Lagarde in the seat. She normally ends up saying something that the euro doesn't like. Not always, but usually. So there can be volatility, but like Ioan said already, I would be very hesitant to try and trade something like the euro tomorrow out of that. There will be volatility and there could be some juicy moves up and down, but I'm not sure whether you'll be able to trade any of that with any meaningful level of conviction, because I don't expect a change from them. Even in terms of the Middle East situation, there's a lot of question marks about how that will impact policy. It's not going to impact policy now, right? If something happens and we do see it translate into higher commodity prices, that will eventually feed into inflation, and that will eventually be a problem. But that is a problem, 4, 5, 6 months from now. It's not really a problem for them right now. So I would expect them to come out mentioning it, saying that they're watching it and they're keeping track of it, but it's not going to change their decision in any way.
Well, I think the ECB are too clunky anyway. It takes them such a long time to respond to anything.
Exactly. They would need to see this actually feeding into higher inflation before they start moving. Obviously, the market will start pricing something in before them. But in terms of their communications, I would expect them to say, yes, we're watching it. But I would expect them to change policy now based on what's happening in the Middle East, unless they see actual evidence that something is changing on the inflation side.
Yeah, I actually often think of the European Central Bank with a similar word to clunky, with quite a few similar letters to it. What's interesting, actually, Arno, is you're saying that's an interesting point that people are looking for a cut first quarter, second quarter next year, which I agree. I just think there's not a hope of next year unless something really strange happens.
Yeah.
At the same time that inflation is going to be accelerating in 6 months' time, and it's this really interesting thing, that you should be saying, God, you should be moving your anticipation of cuts further out because you see inflation accelerating, and it's a real sort of like mismatch of expectations, and whether that's just driven by a bunch of teenage kids who don't know the markets and haven't been around for very long, and they've only got used to low interest rates, and that's what they're praying for because that's all they know, I just don't understand this constant.
I think that comes down to what's happening in Germany at the moment, with Germany slipping into recession. I think that's where the pricing comes from.
Yeah.
As a counterpoint to that, the Fed is expected to cut just a month later.
Yeah,
bonkers. Which, if you look at the data now, that if you compare that with the ECB data, if it was down to purely data or recession expectations, then the Fed mark should probably be pushed out at least by 4 or 5 months. So I don't know. The money markets are just it's in a weird spot looking into next year.
It is bizarre. I mean, I'm inclined to agree with Ioan in terms of it being a bet on slowing growth rather than the inflation side of things. But as we've said numerous times on this show before, are central banks going to cut if growth slows and you've still got inflation double or more their targets? I would argue probably not. Dick, your mention of teenagers reminded me, it's the first opportunity that we've had to do so on this show. Very belated happy anniversary for your 50 years in the city, my friend. Right, well, we've had plenty of UK data out over the last couple of weeks. Dick, this is almost your specialist subject at this point. So we've had jobs, we've had inflation, we've had retail sales, public borrowing, flash PMIs yesterday. How do we distill it? What does it all mean? And I guess the real question is, how much pain are we going to have to bear here in the UK?
I think we're going to have to bear a lot of pain. And I think people are starting to bear pain quite markedly. Mortgages are still rolling off. Higher rates are coming in. Amazing seeing gilt yields. I thought trust must be back in power. All of a sudden they can't blame trust and they can't blame Brexit. What on earth is Reeves going to say about Tories destroying the economy?
Remember, Richard, it's the lags. There's lags to it. So it must be that.
Have you been blocked by her yet?
By Reeves?
Yeah.
Yeah.
Okay.
Yeah. I called her clunky.
Oh God!
Or something like that. I can't remember the exact word, but it was something like clunky.
Well, let's hope you don't remember the exact word for the next half an hour or so.
I certainly won't be saying it. Yes, I have been blocked by because I actually think that she is an idiot, and I think it's duplicitous to attack the government for something which is out of the government's control and out of Truss's control and was actually driven by events elsewhere. And I just think it's really cheap and stupid of them, and you'd expect better of a political party. Well, no, one would hope you'd expect better of a political party, I should say. Interesting. I was talking to Chris Mills from Drax earlier this week, who's an ex-Bank of England trader, and he pointed out that the Bank of England is there for the good of the people, and that's how the Bank of England should operate, which is quite interesting, bearing in mind what they've done. And people are hurting, and I talk to my relatives and friends, and they're having a really, really tough time, and people are not working in the city and scraping away. So I think it's really, really difficult. The employment numbers are good, the wages are still growing a little bit too much. So you could argue that they should hike again. I don't think they should. I think they should now wait and see what happens. I still believe we're going to see a second round of inflation coming through for the reasons we talked earlier about higher commodity prices, oil, etc., etc., etc. But I think they should wait and see what happens. The only other thing I think particularly about sterling at the moment is the political risk. I said, trying to be outrageous a couple of weeks ago, that I think Sunak could face a vote of no confidence. I actually think he could. The only thing is, who on earth would you replace him with? Roland Rat? I don't think there's another leader.
No, you need
another leader in Parliament. To be fair,
you need something that doesn't speak like Mr. Blobby or something.
Quite hard. Who's got more intelligence than Mr. Blobby? That would be the challenge. I think that he could face a challenge, which would be, well, what have they got to lose? They've lost the next election, so what have they got to lose? God knows who they'd have as a leader. I just don't see one there. So I think you might see a bit of political pressure coming on cable, or on the cable. But really, if you're asking me about cable, I think it's driven by the dollar entirely.
Yeah.
It's not so much domestic. What's happening in the UK or in Europe, I just think it's all dollar driven and risk.
Yeah, very much so. I must admit, I disagree with your expectations or even the possibility of a no confidence vote. I mean, if that were to happen, I think it would make what's currently going on with the GOP in the House over in the US look organized. I mean, that's an absolute farce. It would be that times 10 if we were to go through, another Tory leadership challenge 12 months from an election over here. But let's give me the opportunity to use my favourite word, defenestration. Oh, very good. Very fancy, Dick.
God knows what it means.
No, I haven't got a clue either. I'll Google that while Arno's giving his answer to this question, which is where do you think sterling's going to go next? I mean, cable was up towards the 123 handle a little bit earlier on in the week. I mean, is that a rally that's built on very, very shaky foundations, or is there anything that can make one a little bit more constructive on sterling here?
No, I don't think so, mate. I mean, fundamentally, there's very little to like about sterling right now. Like you already mentioned, the data is borderline stagflation. We've got GDP slowing, PMIs weren't great, inflation still way, way, way too high. I mean, not just by itself, but just compared to any of the other majors. I mean, it's really, really ugly. Retail sales was ugly as well. And we've got the mortgage issues, which is still to come into effect as well in the months ahead. So I remain of the opinion that the BOE, unless we get another supply shock, they have their hands tied right now on the hiking side, given the outlook for the economy. And even though, we know wages are still too high, they've recently basically told us that they're not too concerned about that, saying they're seeing it more as an outlier. So in other words, if something doesn't confirm your priors, just don't look at it type of thing. Just pick and choose whichever ones you want to focus on at that time. So I think with the bank likely to pause and the data still pointing to stagflation, the incoming mortgage issues, I don't see a lot of reasons to like sterling right now. For traders, it's always important to keep in mind that the markets, it doesn't just move in a straight line. So even though we've had really good reasons to be short sterling over the course of the last, let's just call it two or so months, It has now reached a level of saturation, maybe in the short term, which can lead to some mean reversion risks. But I think that is what we're seeing right now. I think the upside we're seeing in the sterling is just based on mean reversion flows we're seeing. I don't think there's any fundamental reason to like it. Obviously, if the dollar starts trading a little bit more softly, like Dick rightly said, I do think a lot of that is dollar driven, but also more differential driven. Again, if you compare the US and its data to the Eurozone or the UK, there's very little to like about it from a fundamental perspective. That probably means, you want to be, the dollar is also looking a bit saturated at these levels. So I wouldn't be looking to trade pound dollar necessarily. I might lean more, as always, towards something like euro sterling. That's something we've traded higher for quite a while now. That's something I think makes a bit more sense, even though the Eurozone is looking ugly as well. The differentials, strangely enough, is actually pointing to the upside for the pair in the short term, which is quite interesting. But that's where I think the risk remains tilted to the downside. Balance of risk is tilted lower. I don't see a reason to really like it right now, fundamentally speaking.
No, I would strongly agree with that. And it's taken us until the third round for me to notice what's on your computer in the background. So you've managed to circumvent our rules on a technicality there. So well done, mate. Ioan, moving on, we've got three sort of sterling and UK bears on the panel. Are you going to make it a full house?
Yeah, I think so. I mean, the environment sort of softening a little bit now. I mean, I know that the cumulative effect of like past tightening hasn't really worked its way through the British economy. I think referring to my learned gentleman's previous points about the mortgage issues, I think we've got about 800,000 mortgages rolling off from fixed rate this year, and then that goes up to like 1.5 million people or more next year, where their 5-year rates start to roll off. So I think that's probably one of the reasons why those cumulative effects haven't come through. That people have been sort of isolated from rate hikes because they have fixed mortgage payments. So they've been able to cut back on their spending to some degree. But saying that, I think the labour market is softening. The number of payrolled employees, fell for a third consecutive month through September. And wage growth is starting to moderate a little in the private sector. So I mean, there are headwinds starting to build in the economy in that regard. But turning to the meeting next week, I think there's nothing really that is likely to persuade them to hike at this stage. I think CPI it is set to fall quite sharply, because when last October's 2% jump drops out of the 12-month comps, so the headline figure might be pleasing in some regard to the market, but I think it just seems that the bar is quite high for further tightening from this stage. But one piece of anecdotal evidence that I think it's worth highlighting was the GfK consumer confidence number. The most recent one showed that it was the biggest month-on-month drop since the start of COVID. Now, obviously the outlook for the UK consumer is very important because consumer spending accounts for about over 60% of UK GDP. So you have to follow these type of numbers. But there was there was a deterioration in the willingness to buy and the assessment of their own finances. But so I did note one line from that release, and it said the volatility we are seeing in consumer confidence is a sure sign of a depressed economic mood, and there's no immediate prospect of any improvement. So the only person I can think of that would make that line would make happy is Dick.
Thank you very much. I'm not Mr. Doom and Gloomy, although I was very doom and gloomy last night when I saw that Mayor Khan had given a 10% pay rise out to 130,000 workers.
Oh, is he?
Waiting.
Oh,
God. 130,000 workers or something? I mean, just no wage inflation, is there?
Well, unless you're a worker in London, I guess. May I hasten to add, not this worker in London.
No,
right.
But put me on mute when we talk about Mayor Khan. So
yes, I was going to say, but before we end up with Dick getting himself in trouble, let's get on to the last round. Right, Arno, let's kick off the final round with you. I mean, obviously, we've still got the situation, the conflict going on in the Middle East between Israel and Gaza. Of course, we must recognise the tragic human cost of what's going on, first of all. But from a market point of view, sentiment clearly remains pretty fragile. I mean, gold and crude appear pretty underpinned. We've seen twice now into the weekend what I would imagine are hedges being placed going long both of those. How do you see the markets kind of grappling with this going forwards? I mean, are we still in what you would say is a headline-driven market, or are we starting to get towards the point where markets may be able to look past and begin to look through some of what's going on in the region there?
Look, firstly, I think I'm not sure what the bulls are so worried about, because clearly we just need one tweet, from Bill Ackman to say that he's getting out of his short bonds, and suddenly you've got a problem solved, at least in the short term. But no, in terms of Middle East, it's I think always important when we have these types of situations to look at prior examples when we've had something similar. And what tends to happen with these geopolitical situations is markets normally freaks out a lot more in the short term on negative geopolitical news, and they tend to price in positive geopolitical developments slightly longer. There was a very good research piece from, I think, State Street Advisors 2 years ago on this topic, which was, if you Google it, it's a very, very handy research report to go through. But what we tend to see is markets freaks out very quickly on the negative news, but they also tend to discount it even more rapidly than they priced it in. So if you take a look at gold, for example, with the Russian invasion of Ukraine last year, we had gold spiking up almost 10% in about 7 sessions, and it took just 6 for the markets to reverse that entire move. Similar story with oil. I think that jumped up close to 40% in 6 days. It wiped it out in about 5. So I do think it's important to note that whether you take a look at commodities or equities, the markets tends to get used to these types of announcements very, very quickly. Think back to COVID as well. There was a time when the markets were so focused on it, and every single headline almost is market moving. But after a couple of days, weeks, etc., the markets just get used to it. And I think unless we see a material escalation picking up, I don't see this really creating a massive gyration in the markets, unless, like I said, there's a huge regional conflict which spills into something bigger. If that happens, obviously the markets will need to price that in. But I think where we are now, we're at the risk where the markets are still, financial media rather, is still super focused on this situation, but it feels like the markets are kind of, starting to discount it a little bit, looking at the price action. I mean, crude had a huge push to the downside over the last 2 sessions. Gold is still fairly close to the highs, but it's starting to push lower as well. So I think the markets are starting to get used to it. In my mind, I'm not that focused on the Middle East right now, unless, like I said, we spill over. The 2 things we need to watch right now, I think, firstly, is Treasury yields. If we see any further bond issues, we've got, I think, the 5 or the 7s coming up today in terms of auctions. If we see any major demand shifts, again, problems with demand, forcing yields higher, that's obviously a risk we need to watch for equities. Apart from that, we've seen a big ramp up in implied as well as realized vols. If we see realized vols pushing up meaningfully, I think the market will start to take notice. But those 2 things, I think, is in the driving seat right now, not really the geopolitical situation. Again, if it escalates, yes, the markets will start to focus on it. But where we are now with the lack of any... Because what happens is, in the short term, you get all of these doom and gloom expectations, right? Or this could happen, all the would have, could have, should haves. And the market freaks out about that a little bit. And then when those things don't happen, the market's kind of just, takes a sigh of relief or breathes a sigh of relief. And I think that's where we are now. So unless we see that really escalating, I think watching yields and watching implied versus realized vols is where my biggest focus will be for risk assets at this stage.
Yeah, very much so. And I think that is starting quite rapidly to become a bit of a consensus view. It's not so much a stalemate that we're looking at, but it's more just the fact that there hasn't, thankfully, been this escalation into other regional players, which is allowing market participants to start to turn back to some of the other things that are going on, not just in terms of treasuries, but you look at the economic calendar. We're in what is probably the busiest week of earnings season this week. We've got the Fed coming up next week, the Bank of Japan as well, which I'm sure we'll get into on the show next week in a bit more detail. So there's other things. The market has sort of other and bigger fish to fry at this point. I mean, Ioan, is that how you're looking at things, or do you think it's actually folly that markets are playing things this way, and actually there's risks there that we should still be very, very much attuned to?
I think there are risks everywhere, but at the same time, I mean, we have wacky moves in all asset classes. So I think there are dislocations everywhere. So saying that, like, how do we trade the Middle East conflict? I mean, we don't. That's the simple answer. You should have core positions that you're in or you feel comfortable with, and you just trade around those. There's obviously going to be a lot of headline risk. There's calendar risk now as well, because we're coming towards year end. If you've got like decent performance, what's the point of pushing it at this stage? A lot of US investment banks, their year ends at the end of November. So for the next few weeks, they might not be as active in the market as what they normally are. Having said that, what's the best hedge against risk? I'm just looking at the dollar yen chart now. I mean, that 150 level is really interesting, but I don't think that's a symptom of geopolitical risk. I think the market is on guard for probably unscheduled bond purchases or intervention in that market from the Bank of Japan, as you just mentioned, that they're coming up next week. But saying that, there was speculation back that they could defend it in thin trading early on Mondays or whatever. But I mean, the optionality is there, right? So that's in the back of people's minds, but that's not a geopolitical issue in itself. I think, as Arno referred to there on gold, I think the price action has been like quite interesting. I mean, we know for the most part it's considered a hedge against geopolitical risk and or inflation. I mean, that's what it historically has been, then, so to speak. So, but looking at the commitment of traders report, there was a massive 42,000 contract swing to a net 15,000 long managed money, and this was all from short covering. So effectively, Specs bought 56,000 contracts, which was the fourth biggest in the last decade. So I mean that explains that relentless rally that we've had in gold. But why and again that pushed through gold through a load of resistance levels without the pause. So large speculators' positioning is still not stretched. So there is a lot of room to run higher. But why are people moving into gold? And why is there that much interest? I think that's definitely something that we should that's worth a look. And I'd keep an eye on the commitment of traders report every Friday afternoon, because I genuinely think it's one of those really interesting trades that's worth following.
Yeah, definitely. Excuse me, Dick. Let's wrap up the show with your good self. What are your thoughts on everything that's going on, not just from a market point of view, but also, are there going to be any sustained macroeconomic implications of this, or is it just an elevated level of uncertainty that we'll have to grapple with for the time being?
there's an elevated level of someone with a digger outside of the window, which you'll have to forgive the noise in the background. I can assure you it's not a machine gun. It's someone digging up their patio, hopefully to bury their wife.
Oh, God.
Do you live next to the West?
I tend to disagree with a little bit with the other two. I think that the elevated level of risk is absolutely right. I think the whole situation in the Middle East is a powder keg. I find it very hard to see Iran not being tempted to intervene. I don't necessarily think they'll intervene militarily. I think they could well shut the Straits of Hormuz, which would push oil, obviously, through the roof. I just think it's too good an opportunity for them to resist doing that. I suspect you can feel their hand in everything that Hamas does. I think it's a really, really worrying time. I also look elsewhere. I look what's happening in the South China Seas between the Philippines and China and confrontation there. You look into mainland Europe, you look at Serbia and the Balkans, which again is not really reported in the press. It's getting more and more tense there. Azerbaijan, Armenia, the confrontations there. And then you see these odd things, as I alluded to earlier, about the gas pipelines and communications going. So to me, without a shadow of doubt, we're in World War III. I know that you often accuse me of being a warmonger, but if you look at what's going on worldwide, it's very hard not to take that view. And you're not going to see a war like we had the Second World War, the First World War, when you see masses of troops. This is really, really different. It's going to be cyber war. It's going to be hypersonic missiles. You're not going to have these land battles. So, I know it's awful, and I do feel really doom and gloom about it. And then you look elsewhere, and what is there to encourage you? The weather patterns are completely bonkers, and I don't necessarily buy hugely into global warming as a man-made event. But I do see there is global warming, and you're getting more and more weather shocks occurring, and this is hitting into cocoa, into orange juice, into rice, all sorts of different things, which probably none of us have ever really talked about or looked at before. So I think the world is in a really, really dangerous place. I would be a very, very defensive portfolio. I've never really been a believer in gold. I can't see the point of it. You can't eat it or drink it. I personally, I'd stock up with caviar and vodka, but I'm not sure you could buy a sensible amount and make it worthwhile. You all laughed at me when I said buy Bitcoin a week or so ago, and it's not just because I'm working with a crypto company now and I'm becoming more enamored with cryptocurrencies, but actually it is non-political. It doesn't have these dreadful overtones which the world sees on the dollar now.
But he'd be moving to El Salvador next.
Well, it's very tempting. The world is against the dollar, which is terribly, terribly sad. And I think that people, when they're looking for a safe haven, now will look at alternatives. I'm not a Bitcoin trader, but I would keep an eye on what that does. And as I say, I don't like gold, but I keep an eye on gold as well. And a real odd one from my past is buy stud lumber, because in times of war, you always need lumber to reconstruct what you've bombed. So I'll leave on that cheery note.
Well, I'm really glad I asked the question. Now I'm off to, while you go and buy your vodka and caviar, I'm off to go and buy a tin hat, I think. But before we do that, let's have a look at the scores on the doors, shall we? Sorry,
there's something there.
It's a miracle.
Bloody
Dick,
hell.
how have you pulled that out the bag?
Do you know the best thing about this is Arno lost by 1 point in the last minute.
Nice. Okay.
I'm going to keep going until I got
You deserve that.
I know it's officially a tie, but given his track record, Dick, we'll give you the honorary victory. Well done, mate.
Thank you very much.
You've got to give back one of your wooden spoons now. That's the only thing.
Oh, no. I need them for cooking.
Right, well, On the back of that shock result, we will bring the show to an end. Thank you to the gents for joining me. Richard Matthews from 1.io, Ioan Smith and Arno Venter as well from down in South Africa, who has mercifully managed to avoid any rugby references throughout the show. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know your thoughts on what we've discussed and how you're trading the markets. And we'll be back with another show in a week's time. Thanks as always, and goodbye for now.